Are you ready to learn the secrets of smart investing? In The Intelligent Investor, Benjamin Graham shares timeless principles that can change how you think about growing wealth and managing risks. Imagine following strategies that even Warren Buffett swears by. In this video, we'll break down these key lessons, showing you how to make wiser, long-term investment decisions to secure your financial future. Let's dive into the world of value investing and unlock the path to true financial success. 1. Investment vs. speculation. Are you truly investing or just gambling? Graham emphasizes the difference between true investing and speculation. Investing is about careful analysis, focusing on safety and satisfactory returns, while speculation is like gambling, taking on high risks in hopes of high rewards. Example: an investor buys shares of a well-established company with a history of steady earnings growth, expecting long-term returns. In contrast, a speculator might buy a hot tech stock without researching its fundamentals, hoping for a quick price increase. How to use it in life. Always analyze before investing. Avoid speculative hot stocks or trends unless you're prepared for the risks. True investing requires discipline, patience, and a focus on the fundamentals rather than short-term price movements. 2. The principle of value investing. What if paying less than something's worth could make you wealthy? Value investing is Graham's central concept. He argues that by buying undervalued stocks, those trading below their intrinsic value, you can achieve strong returns over time. This approach requires patience, as undervalued stocks may take time to rise. Example: in a market downturn, a value investor might buy stocks of a company with strong financials but temporarily depressed prices. They wait for the stock to reflect its true value, benefiting from both price increase and dividends. How to use it in life. Learn to evaluate a stock's intrinsic value by studying financial statements, earnings, and market conditions. Focus on long-term potential rather than short-term market noise. Patiently hold your investments until they reach fair value. 3. Margin of safety. What if you could minimize risk and still achieve strong returns? The margin of safety is a cushion against losses, achieved by investing only in assets priced well below their intrinsic value. This reduces the risk of losing money, even if the market fluctuates. Example: if a stock is worth $100 based on fundamental analysis, a conservative investor might wait to buy it only when it drops to $70. This discount offers protection against unforeseen market shifts. How to use it in life. Always seek investments with a margin of safety. Don't buy at any price. Instead, aim to buy below intrinsic value. This approach helps protect against losses and improves potential returns. 4. Mr. Market understanding market fluctuations. What if the market wasn't your enemy, but a tool to help you succeed? Graham personifies the market as Mr. Market, a volatile and often irrational character who offers prices for stocks every day. Sometimes Mr. Market is overly optimistic, driving prices up, while other times he's pessimistic, driving prices down. The intelligent investor takes advantage of his mood swings. Example: during a market panic, Mr. Market may undervalue quality stocks. A wise investor buys these undervalued stocks rather than succumbing to fear, eventually profiting when the market rebounds. How to use it in life. Treat market fluctuations as opportunities. Don't react emotionally. Instead, wait for Mr. Market to offer bargains. When prices drop due to temporary fear, seize the opportunity to buy quality stocks at a discount. 5. Defensive vs. enterprising investors. What type of investor are you, and what strategy fits your goals? Graham categorizes investors into two types: defensive and enterprising. Defensive investors prefer low-risk, low-effort strategies, while enterprising investors are willing to put in more work for potentially higher returns. Example: a defensive investor may focus on safe blue-chip stocks or index funds, while an enterprising investor might look for undervalued individual stocks after thorough research. How to use it in life. Identify your risk tolerance and investment style. If you're risk-averse, stick to safer, diversified investments. If you're comfortable with research and analysis, you can pursue a more active strategy with potential for greater gains. 6. The power of diversification. What if spreading out your investments could protect you from unexpected losses? Graham emphasizes the importance of diversifying across various asset types to minimize risk. Even the best analysis can't predict all outcomes, so spreading investments reduces the impact of any single poor performance. Example: an investor who holds a mix of stocks, bonds, and cash is better protected during market downturns than someone who invested solely in stocks. How to use it in life. Diversify your portfolio to include a range of assets that aren't directly correlated. This way, losses in one area are offset by gains in another, providing stability through market cycles. 7. Don't follow the crowd. What if the biggest risk was following others blindly? The intelligent investor warns against herd mentality, making decisions based on what everyone else is doing. Graham argues that true success in investing comes from independence and not being swayed by market fads. Example: during the dot-com bubble, many people rushed to invest in internet companies. Graham-style investors who avoided the hype protected themselves from huge losses when the bubble burst. How to use it in life. Develop your own research-based investment strategy. Don't buy or sell based on trends or popular opinion. Stick to your principles and ignore the noise. 8. Embrace long-term thinking. What if the key to wealth was time and patience? Graham emphasizes that investing is a marathon, not a sprint. While some get-rich-quick strategies might seem attractive, real wealth grows over decades. Example: an investor who buys quality stocks and holds them for 20 years will generally see better results than someone constantly buying and selling based on short-term trends. How to use it in life. Focus on long-term wealth-building goals. Don't let short-term market drops scare you into selling. Patience and persistence often bring the best returns. 9. Emotional control. What if controlling your emotions was the secret to financial success? Graham believes that emotional discipline is key to intelligent investing. Fear and greed can lead to poor decisions, so staying calm and logical during market ups and downs is essential. Example: during a market crash, an emotional investor might panic and sell at a loss, while a disciplined investor holds steady, knowing the market will eventually recover. How to use it in life. Develop habits to control emotional reactions. Make decisions based on facts and strategy, not impulses. Recognize when emotions are influencing you and take a step back. 10. The importance of self-education. What if knowledge was your greatest asset in building wealth? Graham encourages readers to continually educate themselves, understanding the basics of finance, economics, and market psychology equips you to make wiser decisions. Example: an investor who studies financial statements can identify undervalued stocks more effectively than someone who relies solely on trends or news. How to use it in life. Make a habit of learning. Read books, study financial reports, and understand market principles. The more you know, the better equipped you are to navigate the investment landscape. 11. The importance of earning stability. What if the key to safe investments lay in a company's consistent earnings? Graham stresses the importance of investing in companies with stable earnings over time. Consistent earnings show that a company can perform well even during economic downturns, making it a safer investment. Example: a utility company with a steady income over decades, even in recessions, provides more reliability than a startup with fluctuating earnings. How to use it in life. When selecting stocks, look for companies with stable earnings over at least 10 years. This indicates resilience and provides a solid foundation for future growth. 12. Dividends as a signal of financial health. What if steady dividends were a sign of a healthy company? Graham suggests favoring companies that regularly pay dividends, as this indicates financial health and a commitment to shareholders. Example: a company that has consistently paid dividends for decades, like Procter & Gamble, is likely financially stable and shareholder-friendly. How to use it in life. Look for companies with a long history of paying and ideally growing dividends. Dividends offer a return even if the stock price remains stagnant, providing a steady income stream. 13. Avoiding the hype of growth stocks. What if high-growth stocks carried hidden risks? Graham warns against getting caught up in the excitement of high-growth stocks that promise rapid returns. These stocks often carry high valuations and can be very volatile, risking significant losses if they don't meet high expectations. Example: during the dot-com bubble, many growth stocks were overvalued, leading to huge losses when the bubble burst. Value investors who avoided these stocks were better protected. How to use it in life. Focus on value stocks with strong fundamentals rather than trendy growth stocks. Remember, high growth often comes with high risk. 14. Inflation and its impact on investments. What if inflation was silently eroding your wealth? Graham emphasizes the impact of inflation on purchasing power, arguing that investors must consider inflation when planning for the long term. Stocks and bonds can both be affected by rising inflation, which lowers real returns. Example: an investor who holds only cash or fixed income assets loses purchasing power as inflation rises, while an investor with equities may better maintain wealth. How to use it in life. Diversify your investments to include assets that tend to appreciate with inflation, like equities or real estate, to protect against the erosion of wealth. 15. Being skeptical of market forecasts. What if predictions were mostly guesses? Graham believes that market forecasts are often unreliable. Instead of relying on predictions, he advises investors to make decisions based on fundamental analysis and long-term value. Example: a market analyst might predict a recession, causing some investors to sell prematurely. Graham's approach encourages ignoring these forecasts and staying the course with quality investments. How to use it in life. Base your investment decisions on facts and intrinsic value, not on market predictions. Let your own research, not speculation, guide you. 16. Avoiding overconfidence. Could overconfidence be your biggest enemy in investing? Graham warns that overconfidence often leads investors to take unnecessary risks or believe they can time the market, which rarely succeeds over the long term. Example: an investor who is overly confident may put all their money into one stock, expecting it to skyrocket. If it fails, they risk losing everything. How to use it in life. Practice humility in investing. Diversify. Avoid betting too heavily on any one investment, and always recognize that the market can be unpredictable. 17. The perils of high fees and costs. What if hidden fees were quietly eating away at your returns? Graham advises avoiding investment options with high fees, as these can significantly reduce net returns over time. Low-cost options, like index funds, provide solid returns without excessive costs. Example: an investor choosing a mutual fund with a high management fee ends up losing a large portion of their returns to fees, while an investor in a low-cost index fund keeps more of their gains. How to use it in life. Choose low-fee investment options to maximize returns. Be cautious of actively managed funds or complex investment products with high fees that could impact your wealth. 18. Embracing simplicity. What if the simplest approach was also the best? Graham believes in keeping investments straightforward. Instead of trying to outsmart the market with complex strategies, he suggests sticking to simple, proven methods. Example: rather than using complex option strategies, an investor who simply buys and holds a diversified portfolio of quality stocks often achieves comparable, if not better, long-term results. How to use it in life. Don't overcomplicate your investments. Stick with strategies you understand and avoid complex financial products unless you are fully educated on their risks. 19. Recognizing market cycles. What if understanding cycles helped you buy low and sell high? Graham notes that markets go through cycles, with periods of boom and bust. Understanding these cycles helps investors avoid buying in euphoric markets or selling during downturns. Example: an investor who recognizes a market peak might avoid buying stocks at high prices, waiting for a more favorable opportunity to invest after prices correct. How to use it in life. Stay patient during market highs and lows. Recognize that downturns can be opportunities to buy quality assets at lower prices, while bull markets may require caution. 20. The true measure of success. What if success wasn't just about money? For Graham, being a successful investor isn't about becoming extremely wealthy, but about achieving financial security and peace of mind. He believes that smart investing should reduce stress, not increase it. Example.an investor focused on financial independence and stability feels secure, even during market downturns, because they've built a balanced, conservative portfolio. How to use it in life. Define what financial success means for you. Focus on building a portfolio that supports your goals and lifestyle rather than chasing maximum returns at the expense of stability. 21. Margin of safety. What if the secret to successful investing was protecting yourself from mistakes? Graham emphasizes the concept of the margin of safety, which refers to investing in securities when they are priced significantly below their intrinsic value. This principle protects investors against errors in judgment or market fluctuations. Example: if a stock has an intrinsic value of $100 but is trading at $70, the margin of safety provides a buffer against loss if the stock's price drops further. How to use it in life. Always seek investments that offer a substantial margin of safety. Avoid overpaying for assets and focus on those that provide a cushion against potential downturns. 22. The role of speculation. What if distinguishing between investing and speculation could save you from losses? Graham defines speculation as purchasing assets with the hope that they will increase in value without a solid basis in their intrinsic worth. He urges investors to be aware of the difference between investing and speculating. Example: buying shares in a hot tech startup solely based on hype and speculation differs from investing in a well-established company with strong fundamentals. How to use it in life. Be cautious of speculative investments. Focus on fundamentally sound companies and avoid chasing trends or fads that lack substance. 23. Understanding market psychology. What if your emotions were sabotaging your investment decisions? Graham discusses the importance of understanding market psychology and the emotions that drive investor behavior. Fear and greed can lead to poor decision-making and market volatility. Example: during market downturns, panic selling can occur, leading to significant losses for investors who act on emotion rather than rational analysis. How to use it in life. Cultivate emotional discipline in your investing. Stick to your strategy and avoid making impulsive decisions based on market noise or emotional responses. 24. Focus on long-term results. What if true wealth was built over decades, not days? Graham advocates for a long-term investment perspective. He warns against trying to time the market and emphasizes that successful investing is about holding quality investments over time. Example: an investor who buys and holds a diversified portfolio of stocks for several decades is likely to see significant returns, while a trader who frequently buys and sells may struggle to achieve the same results. How to use it in life. Commit to a long-term investment strategy. Focus on quality investments that will appreciate over time, rather than seeking quick gains through frequent trading. 25. Be prepared for market volatility. What if expecting volatility could make you a better investor? Graham reminds investors to expect market fluctuations and be prepared for volatility. Rather than fearing downturns, view them as opportunities to buy undervalued assets. Example: during a market correction, investors with a long-term perspective can purchase stocks at lower prices, enhancing their potential for future returns. How to use it in life. Develop a plan for dealing with market volatility. Stay focused on your investment strategy and be ready to take advantage of lower prices during market downturns. 26. Diversification as a risk management tool. What if spreading your investments could reduce your risk? Graham stresses the importance of diversification to minimize risk. By spreading investments across various asset classes and sectors, investors can protect themselves against significant losses in any one area. Example: a portfolio containing stocks from various industries, bonds, and real estate can help mitigate the risk of a downturn in any single sector. How to use it in life. Diversify your investment portfolio to protect against market volatility. Consider different asset classes, sectors, and geographic regions to enhance your risk management strategy. 27. The significance of a business-like approach. What if treating investing like a business could improve your results? Graham encourages investors to adopt a business-like mindset when it comes to investing. This means thoroughly researching and analyzing investments, just as one would evaluate a business opportunity. Example: An investor who treats their portfolio like a business will conduct due diligence, assess risks, and make informed decisions, rather than acting on speculation or impulse. How to use it in life. Approach investing with the same seriousness and diligence as running a business. Conduct thorough research and analysis before making investment decisions. 28. Recognizing the value of experience. What if experience was your best teacher in investing? Graham highlights that experience plays a crucial role in becoming a successful investor. Learning from mistakes and successes can help investors develop a more nuanced understanding of the market. Example: an investor who reflects on past investment decisions, both good and bad, gains valuable insights that can inform future strategies and choices. How to use it in life. Embrace your investment journey as a learning experience. Analyze your decisions, understand what worked and what didn't, and apply those lessons to improve your future investing. 29. The power of compounding. What if time was your greatest ally in building wealth? Graham illustrates the power of compounding returns, emphasizing that the longer you invest, the more your money can grow exponentially. This principle underscores the importance of starting to invest early. Example: an investor who starts saving at age 20 can accumulate far more wealth by retirement compared to someone who starts at 30, thanks to the power of compounding interest over time. How to use it in life. Begin investing as early as possible to maximize the benefits of compounding. The earlier you invest, the more time your money has to grow. 30. Continuous learning and adaptation. What if the best investors were also the best learners? Graham advocates for continuous learning and adaptation in investing. The financial landscape is constantly changing, and successful investors must stay informed and willing to adjust their strategies. Example: an investor who regularly reads financial literature, attends seminars, or engages with other investors is better equipped to navigate changing market conditions. How to use it in life. Commit to lifelong learning about investing. Stay curious, seek out new information, and be willing to adapt your strategies based on what you learn. Conclusion. The intelligent investor provides timeless wisdom on investing that transcends market cycles and trends. Benjamin Graham's principles emphasize patience, discipline, and a focus on value, guiding investors toward financial security and success. By embracing these insights, you can develop a robust investment strategy that withstands market fluctuations and leads to long-term wealth accumulation. Through a disciplined approach and a commitment to continuous learning, you can navigate the complexities of investing with confidence and clarity.